The battle of strategies. In a market shaped by inflation, rising interest rates, tech disruption, and geopolitical shocks, one question reigns supreme. Should you go for fast-growth tech stocks or stick with proven value giants? Welcome to the Great Investing Showdown: Growth versus Value in 2025. Subscribe now for weekly insights that turn headlines into investment strategies. What are growth and value stocks? Growth stocks are companies expected to grow their revenues and profits significantly faster than the market average. They usually reinvest earnings into operations, R&D, or expansion, and rarely pay dividends. These stocks often belong to sectors like technology, biotech, or disruptive industries. Value stocks, on the other hand, trade for less than their intrinsic value, typically because they are in mature industries with stable earnings. They often pay dividends and attract income-focused investors. Classic valuation metrics used include the price-to-earnings, PE, price-to-book, PB, and price-earnings-to-growth, PB/PEG ratios. Understanding the fundamental differences helps investors align their strategy with their financial goals. Historical performance trends. Historically, growth stocks outperform during low interest rate periods and booming innovation cycles, such as the dot-com era and post-2008. Value stocks shine during recovery phases and rising rate environments, such as the early 2000s and the post-COVID inflationary cycle of 2022 to 2023. For example, during the COVID rebound, tech-driven growth stocks soared. However, in 2022 to 2023, with interest rates climbing and inflation sticking, value stocks outperformed due to their defensive nature and predictable cash flows. Understanding these patterns helps prepare for cyclical rotations. Macroeconomic factors. Influencing 2025 markets, the economic climate in 2025 is shaped by persistent inflation, central bank policies, and rising global tensions. Interest rate hikes affect borrowing costs and corporate profitability. AI and automation are disrupting industries, while demographic shifts like aging populations and labor shortages influence earnings and valuations. Geopolitical fragmentation also adds volatility, making investors cautious. These macro forces require more flexible and adaptive investment frameworks. Characteristics of top growth stocks. Today's growth leaders include AI firms, electric vehicle producers, biotech innovators, and cloud infrastructure giants. These companies typically post 20 to 50% revenue growth rates, but trade at premium valuations. While these stocks offer explosive potential, they also carry volatility and execution risk. Investors need to monitor cash burn, market share, and product innovation to validate their continued growth trajectory. Characteristics of value stocks in a changing world. Value stocks often represent large-cap firms in sectors like banking, utilities, healthcare, and energy. Many offer steady dividends and strong free cash flow, making them attractive when bond yields rise. In a volatile world, value stocks offer downside protection, especially during economic slowdowns. Their valuations typically remain grounded, offering potential upside even in sideways markets. Which style wins in high-interest rate environments? Growth stocks, heavily dependent on future cash flows, get discounted harder in rising rate environments. Conversely, value stocks benefit as current cash flows become more valuable relative to growth projections. Case studies from the 1970s, early 2000s, and 2022 confirm value's outperformance during rate hikes. However, when rates stabilize or drop, growth stocks can recover quickly, especially in innovation-driven rebounds. Blended strategies. The rise of GARP, growth at a reasonable price. GARP strategies combine growth potential with value discipline. Investors seek companies growing earnings with moderate valuations, balancing reward and risk. ETFs like the iShares GARP ETF or actively managed mutual funds now cater to this strategy. GARP helps investors stay invested without overpaying for hype or ignoring opportunity. How to build a balanced portfolio. In 2025, diversification remains the cornerstone. Investors can allocate a mix of growth and value depending on age, risk profile, and financial goals. Younger investors might tilt toward growth, while older investors may prefer the income and stability of value. Sector rotation, global exposure, and alternative assets like commodities can further enhance portfolio balance. Risk management and mental models. Investors must guard against behavioral biases, overconfidence, recency bias, and herd behavior. Rebalancing regularly ensures alignment with goals. Stop losses and position sizing prevent emotional decision-making. Long-term success comes from consistency, not market timing. Investor profiles. Who should pick growth versus value? Growth investing may suit young, ambitious investors who can weather volatility. Value investing appeals to conservative investors or those nearing retirement. Understanding your personality, time horizon, and income needs helps match the right investing style. Tools, screens, and metrics for analysis. Platforms like FinViz, Yahoo Finance, and Morningstar allow investors to screen for growth or value stocks using filters like PE, PEG, dividend yield, revenue growth, and debt ratios. Backtesting tools help simulate strategy performance across different cycles, allowing evidence-based decisions. 2025 Outlook. Trends to watch: expect heightened volatility with continued interest rate recalibrations, AI disruption, and global economic rebalancing. Growth sectors may benefit from digital transformation and green tech, while value sectors gain from infrastructure and policy-driven stability. Investors who remain flexible and well-informed will navigate the road ahead successfully. Subscribe now to gain the clarity and edge to choose wisely between growth and value. Growth. Value. You decide, but decide informed.